Hello, I'm Gary Book, Assistant Vice President of Retail Credit Underwriting at Farm Credit Mid-America. And with me today is Ethan McNeely, a credit analyst in Retail Credit Underwriting Department.
Welcome to the fourth video of our Balance Sheet Basics series. For this video, we'll introduce to you different concepts and benchmarks to help you identify the root causes of weaknesses in your balance sheet and ways you can manage adversity in your operation.
As mentioned in the previous videos, working capital is a measure of short-term risk-bearing ability. After you have completed a trend analysis and you recognize a declining trend in working capital or total equity, what should you do? The first thing is determine the root causes of the declining trend. Did the farm experience a loss of net income? If so, was this due to increased fixed or variable costs or lower gross revenues? Were there capital assets purchased with cash? Were there gifts or inheritance paid out, down payments on capital assets, or large one-time expenses made? These are all key questions any farm manager should be asking themselves as they evaluate the previous year's financial performance of their operation.
To help farm managers identify these root causes, we will now introduce two ratios to monitor fixed and variable costs. The fixed cost ratio is a measure of the operation's fixed costs in relation to gross revenues. It is calculated by adding up all term debt interest and principal payments, real estate taxes, and land and machinery rent, and dividing it by gross revenues. A moderate risk fixed cost ratio would be 35 to 40% for grain producers. A 35% fixed cost ratio simply states that for every $1 of gross revenues that your farm makes, 35 cents goes to fixed costs. As this ratio increases, the less retained profit an operation will have to retain to the working capital position.
The variable expense ratio encompasses all other expenses your operation accrues throughout the year. Key components of this ratio include crop inputs, repairs, operating interest, and labor. It is calculated by taking your operating expenses and subtracting term interest, equipment, and land rent, depreciation, and real estate taxes to get your farm variable expenses. Once you have this number, divide the farm variable expenses by your gross revenues to get your variable expense ratio. A moderate risk variable expense ratio would be 50 to 55% for grain producers. A 50% variable expense ratio simply states that for every dollar of gross revenues your farm generates, 50 cents goes towards covering variable expenses.
Once you have identified the root causes and dug into your fixed and variable expenses, you can now identify your operation's strengths and weaknesses. If you have identified that working capital has been declining in your trend analysis and your variable costs are considered high risk, you might address this weakness by reducing variable expenses through input costs or increasing gross revenues through better marketing to cover the increased expenses. Monitoring these two ratios will allow you to see what the majority of your expenses are going towards and allow you to analyze all costs of your operation. If fixed and variable costs are kept within a low to moderate risk category, then the likelihood of net profits and working capital build increases.
There are also benchmarks to monitor capital allocation. Money spent on equipment and other depreciable assets is important to monitor for any operation. Equipment values should be less than or equal to 75% of your gross revenues. Equipment costs, which includes equipment rent and equipment payments, should be less than or equal to 10% of your gross revenues. As these two ratios increase, you may not be fully utilizing your equipment, and those funds could be going back into working capital or to pay down existing debt. Depreciable assets are necessary, but not the most effective in generating real wealth.
The final benchmark to review is your land cost as a percentage of your gross revenues. This includes land rent, land payments for acreage and facilities, and taxes. This should be 30 to 35% of your gross revenues. Much like the equipment cost ratio, the higher this ratio goes, the less funds your operation has available to build working capital and increase retained profit.
In this series, we have defined the importance of the balance sheet, discussed the ratios the balance sheet can help you calculate, reviewed the trend analysis, and identified how to manage adversity in your operation. We hope you found this material beneficial, and if you would like the additional information, please reach out to your local Farm Credit Financial Officer.